Good evening, everyone. Time for another silver update. This is the chart we want to keep an eye on. This is the crude oil chart provided by netdania.com. You can click on the link below. This is going to be the key to what we're looking at here. Not a lot going on in the precious metal, so I want to take tonight to learn about the trade balance, the trade deficit, trade surplus, because it's a big news story hitting the wires here, and I want to dig into this and explain this. So first, let's look at all of the panic stories that we've got here. You can see this is just 10 minutes ago from Reuters. Asia shares stumble as weak China trade stokes growth worries. Weak China trade. Now, you know, I point out for the longest time that the American press just simply lies about what's going on in China. It is so absurd. They are such pathological liars when it comes to what's happening in China, which is China is going up and we are going down. And that's all there is to it. There's no getting around it. They're growing. They're getting stronger. They're the most powerful nation economy in the world. They're going to grow multifold from here. We're going to shrink enormous percentages from here. We will be just a little tiny speck once this is all through and over and done. But you can never get that from the media because they're pathological liars, and I'm going to prove to you tonight. Okay, so here's the big story from Reuters. The stock markets in Asia are tumbling because of weak China trade. Then we've got another story on Reuters. China's imports slump, capping dismal January trade performance. Here's Bloomberg. China's record trade surplus highlights weak domestic demand. And here's Zero Hedge getting in on it as well. Chinese imports crash, and worst January export plunge since 2009 sends trade surplus to record high. And I'm not even going to bother to read it because it's such a bunch of nonsense. So let's get some real information first of all before we go and debunk all that nonsense. This is the best article that I could find explaining trade deficits and trade surpluses. We're going to read this, and then we're going to go and actually look at the facts. We're going to look at what is actually happening with the trade. Now, I want to remind you that trade deficits and trade surpluses are not just between two countries. They're between that country and all of the rest of the world. So, for example, if the United States is running a trade deficit with China, that doesn't indicate whether or not China is running an overall trade surplus or deficit with anyone else, because you have to add in all of the other countries. So pointing to China and blaming it for the United States' problems, or pointing to the United States and blaming it for China's problems, is stupid. The problems that a country has are its own fault, the fault of the politicians in that country. So I want to make that clear. But let's read this. This is going to give you a foundation to look at the numbers and understand them. We're doing a series of explainers of economic concepts to mark Marketplace's 25th anniversary. The United States has been running one every year since 1974. Currently, the trade deficit is about $40 billion or so a month, give or take a few billion. A trade deficit, you probably heard, is when a country is buying more from the rest of the world than it's selling to the rest of the world, importing more than it is exporting. That may sound bad. If I personally ran a trade deficit for 40 years like the U.S. has, I would be broke. But I'm not a country, and the rules are different for countries. There's actually nothing necessarily wrong about a trade deficit, says Doug Irwin, professor of economics at Dartmouth. In fact, here's where economists always have a definitive answer to the question, is a trade deficit good or bad? And that definitive answer is, it depends. Depends on what exactly? Well, before we can answer that, we have to explain why it's so neutralish in the first place. The reason is that trade deficits have this whole other side to them that is not obvious at all. Trade deficits actually have as much to do with international investment and debt as they do with importing and exporting. It's invisible unless you look at the money. So let's look at the money. Let's say the US and Europe have a trade deficit, which they do, meaning America imports tons of French wine, let's say, but exports almost nothing to Europe. Wine stores across the US will place their orders with wineries in Europe for massive quantities of Beaujolais and Chardonnays, and they will, of course, need to pay in euros. French wineries don't want a stack of Benjamins any more than you want that darn Turkish lira that somehow always ends up in your bag of change when you're trying to pay a toll on the freeway. So the wine stores or the bank or the credit card company the wine stores use will have to take their US dollars to an international currency market and convert them into euros to give the French vineyard to buy the wine. Since the U.S. is buying massive amounts of French wine, that bank is going to have to convert massive amounts of dollars into euros. Here's the problem. We have a trade deficit. We aren't exporting much to Europe, as in Europe isn't buying our stuff, which means they don't need dollars. Why would they need dollars? To use as paperweights. Now, you can imagine one way out of this. American banks might have to lower the price of the dollar. They might say, fine, world, what if I give you $110 for $100 in euros, 120, 150, until finally someone in Europe decides that it was a really good deal and they could use some dollars to maybe buy some American goods. It's kind of an auto-correct feature that trade deficits can have. When the dollar falls, that stimulates U.S. exports, it discourages U.S. imports, and that fall in the value of the dollar will naturally begin to close the trade deficit, says Irwin. This can happen with trade deficits. They can push down a currency's value. Now keep that in mind, because this is the check engine light, if you will, for the U.S. economy that we've unplugged, because we're not letting these trade deficits push down the value of our currency. In fact, the value of our currency has been rising due to various reasons. Now, we're going to see other things that we've short-circuited, and we'll see why this doesn't apply to us, but let's keep going. But that's not happening with the U.S., nor is it happening with a lot of countries. The dollar is doing great, and yet we continue to import much more than they export. Somehow we are finding another way to deal with the problem that we can't get Europeans to exchange our dollars so we can buy European wine. The fact is, there are people abroad who want to give us euros in exchange for dollars. These are people who want to buy, not people who want to buy our stuff. These are people who need dollars because, drum roll, they want to invest in America. They're investors. Investors need U.S. dollars to buy U.S. assets, treasury bills, real estate, stocks, bonds, etc. After all, the NASDAQ doesn't take euros, so foreign investors need dollars to park their money in the U.S. and make a profit, just like we need euros to buy wine. That's how the U.S. economy finds the euros to go import crazy. So if we're having a trade deficit, it's a sign that someone abroad is investing in some part of our economy. A trade deficit and investment are like two sides of a strange coin. We buy goods from the world, and the world invests in us. This invisible connection between trade deficits and foreign investments is why a trade deficit can be good or bad. All it means for sure is that other countries are coming to you to invest their money. That can be great if it's growing your economy, or can be bad if it's not. You can't tell what's going on just from having a trade deficit. So if this is correct, which, by the way, I don't believe it is, I don't believe that the money is coming here. There's no mention of the petrodollar. But let's say he's correct, that the money is coming here for investments. Is the rising stock market, is that growing our economy or not? The good. An example of a trade deficit that was happening for good reasons was the U.S. during the 19th century, says Robert Lawrence, who teaches international trade at Harvard's Kennedy School. The U.S. had increasing trade deficits, which were made possible by investors pouring in money from abroad. The United States used the money to build railroads, build the U.S. economy. So you can look in retrospect and say that was a pretty healthy deficit. The bad. An example of a trade deficit that was happening for less good reasons is Greece, he says. During the financial crisis, Greece was running a trade deficit made possible by investors who were pouring money into the purchase of government debt. During the global financial crisis in Greece, the government accumulated large debts, so large, in fact, they couldn't repay them. So let me ask you this question. Is money flowing into the United States for the good reasons? Are we investing in infrastructure? Or is it flowing in to buy debt? And why would it be flowing in to buy debt? Or maybe it's not flowing in. Maybe the Federal Reserve is buying the debt. The ugly. Sometimes it can be okay to finance government debt, but if something scares investors and they take all their money out at once, like happened in Southeast Asia in the late 90s, that can spark a crisis. In cases like those, a trade deficit can be a sign of vulnerability. So a trade deficit, strictly speaking, means investors are parking their money with you. Whether it's good or bad depends on what you or they are doing with the money. The U.S. is lucky because investors keep coming back. As long as they do, we can import more than we export. But what happens when they don't? So why do they invest in the U.S.? Certainly not because of interest rates. Is it because of the rising currency? No, that's only been recent. Maybe it's the rising stock market. So what happens if the stock market stops rising? So let's go back to these stories here and look at what they actually said happened, and then we're going to look as to what that means in reality, not what they say here. Here's what they say on this story. Asian shares wobbled on Monday after dismal Chinese trade data. Okay, what was the dismal data? Well, the dismal data published on Sunday shows China's trade performance slumped in January, with exports falling 3.3% from year-ago levels, while imports tumbled 19.9%, far worse than analysts expected. The data highlighted deepening weakness in the Chinese economy. Okay, so there's your big explanation. You get the same thing in this one, just varieties of the same thing. The big number here is going to be this 19.9% decline in imports. So why do you think China had a 19.9% decrease in imports? Yeah, well, let's go look at China's trade. Here's the United States, and here's China. Now, remember what I said, that just because the United States runs a trade surplus with China doesn't mean that China has a trade surplus or deficit either way. All the rest of the countries in the world could be doing something different with China. So you have to look at every country independently. But this will show us not only what the top imports and exports are, but the other top countries. So let's start out with China. Well, guess what we find out? The first thing we find out. This column over here, what does China import and what does China export? Well, look what we find when we look at what China imports. Crude petroleum. And that's going to be compared to refined petroleum. See that down at number 7. So 14% of China's imports is crude petroleum. Now, how far did the price of crude fall? From about 105 down to 50. So the price of crude was cut in half. You think that's probably what accounted for the 19% drop in Chinese imports? China didn't change the number of barrels of oil that they were importing. China probably increased it or kept it nearly the same. But the price of that oil dropped dramatically, which means that they had a massive trade surplus. Is that a good thing or is that a bad thing? Now think about that. Now, so we have imports for China, crude petroleum, integrated circuits, which, by the way, these integrated circuits are just going to turn around and go into these computers that are their top Computers, broadcasting equipment, telephones, and office machine parts. These integrated circuits are going to be manufactured into these things they're exporting. So the first one is a raw material. That's going down in price. The second is integrated circuits, which is a component of manufacturing, which will help their exports. The next, raw material, iron ore. The next, gold. Their number 4 import is gold. What does that tell you? Now let's look at the United States. Top import, cars. By a lot. We buy cars and computers. Then we import crude and export refined. Medicines, broadcasting equipment. Now if you look at our exports, we export cars, yes, but only a third of what we import. We export refined petroleum. So we bring in the oil, we refine it, and export it out. Planes and helicopters, and then medical medicine, stuff like that. So what are the totals here? You can see products imported by the United States, 1.8 trillion. Products exported by the United States, 1.23 trillion. $600 billion trade deficit. Is that going to be a mirror reflection of China? Of course not, because China does business with the rest of the world. But it is. You can see it's close. That's why people say that it's China's fault. What does China import? China imports 1.4 trillion and it exports 2.12 trillion. So it's actually $700 billion trade surplus for China. So China is doing excellent. America is doing terrible. Where is that $600 billion a year coming from? Who's buying our stocks? Maybe foreigners. What happens when that ends? So let's look at the USA and let's look at the countries. Here are the number 1 through 5 countries that the United States imports from: China, Mexico, Canada, Japan, and Germany. Here's are the countries we export to: Canada, Mexico, China, Japan, and Germany. It's the same 5, it's just a different order. Now let's look at China. Here are the countries that China imports from: Japan, South Korea, other Asia, United States, and Germany. And the countries that China exports to: United States, Hong Kong, Japan, Germany, South Korea. Now, the first thing that you're going to notice here that doesn't really make any sense. Other Asia, what's that? Secondly, remember we showed you that China's number 1 import is oil, crude oil. Is China's crude oil going through Japan? That doesn't make any sense. Maybe it's a whole bunch of countries added together. Well, let's look. Here's Saudi Arabia. Here's Russia. Iran. So maybe a whole bunch of little countries add up together and make that. The other thing to note here is that it is not those main countries here with this side here on where China exports. China exports to Hong Kong. What's going on there? Well, I'm not really sure. But that's number 2. Then we've got Japan, Germany, Korea. So anyway, the upshot of all this, you can see that these headlines are totally misleading. That they could report that because the price of oil dropped so dramatically and that caused China's imports to drop, and that's a negative for China. Or that they could say that the reason that China's imports drop is because it's a dismal trade performance, or they have weak domestic demand. Do you see how every news story, regardless, is always spun as negative for China and positive for the United States, when the truth is exactly the opposite. It is China that's doing everything right in this trade thing, and it's the United States that's doing everything wrong. And once the investment demand that soaks up the difference of the trade deficit of the United States, once that disappears, that's when the United States goes into hyperinflation and the dollar collapses and interest rates skyrocket. And we'll talk to you next time.